So obviously when we say future is a contract, and that is going to be a standardized contract. It is not like a forward contracts. So when compared to forward contracts, which is a standardized contract, and it is traded on an exchange. So since it is being traded on an exchange, so the participants in the markets are okay. So obviously it is not like, let's say for example, if you are going for a vegetable market, probably you will go for a regional market, and the supply, both demand and supply, may be from in and around the city only. But whereas when we are going for a stock exchange like NSE, BSE or MCX, NCDX, now the participants can buy or sell from anywhere in the country. So that's where the advantages of standardized contract, the advantages of exchange traded contract is. Okay, so obviously when whether it can be a currency futures or it can be a commodity futures, so absolutely the advantages are going to be the same. So that's only the underlying asset is going to be different. Now, so what we can do? So basically, like we have got only two strategies in the currency futures or in commodity futures as far as future is concerned. So when I say two strategies, either you can buy or you can sell. Okay, and this is the one which we can do. So when I say buy and sell, basically let's say for example that's called long futures and the short futures. So long futures, where you are trying to buy if you are expecting the price of the underlying asset is to increase. So you buy futures contract so that once the price increases in the future date, as per the agreement, you can take a delivery at the agreed price. So that's the added advantage. What if the price comes down? So still you have to buy for the agreed price. So if I'm just going to draw a expected profit or the expected loss in terms of graph, so your x-axis is going to be your price and y-axis is going to be your profit or the loss. Assume if I'm buying it for 100 rupees. Okay, so I'm just buying it for 100 rupees. What if the market increases? 110, 10 rupees profit, 120, 20 rupees profit, 130, 30 rupees profit. See why I'm getting at 130, I'm getting 30 rupees profit? Because I entered into an agreement with the person saying that okay, I will buy the product only at 100 rupees. Whereas the market price has increased in the future date, obviously I'll buy only for 100, even if I sell immediately in the market price. So I'm going to gain a profit of 30 rupees. And this is what the major gain, the gain which I can get it. So likewise, if the price started going to an unlimited level, the profit also can go up to an unlimited level. So this is on one side. But on the other side, if market is going against to my expectations, so what will happen? So if the market is going against expectations, mean if 100 becomes 90, so you'll make a loss of 10 rupees. So this is minus 10 and this is minus 20. So now this is going to be the loss. To what level it can go down? So even though we say theoretically it is unlimited, but practically it cannot go below 0, usually in the case of currency futures, even in the case of commodity futures also. But we had a history in crude oil, at least okay, in the recent lockdown period, where the crude oil goes on a negative price. Why? So because of the logistics and because of the storage. So the major issue is the storage and the logistics issue. So to avoid this, people started selling the crude oil at the negative price on the expiry day, because that is going to be your last day. So either you have to consume the product or you are going to. So considering this, so we have got a negative price. So theoretically it cannot go below 0, and practically for some reasons on the expiry day there is a possibility for the commodity price can go below 0, like crude oil. We have got a history now. So almost from 2003 to till today, till to 2020, so we have not heard of any negative prices in commodity markets. But 2020 has changed everything. So 2020 has given you the negative price in the commodity markets. So this is the one thing which we need to remember, only in crude oil. But that's an exceptional case. I think it may happen once in 1,000 years or once in 100 years. So it depends. So this is going to be the case. This is what long future is. Similarly, we have also learned about what a short future is. So basically, I'm expecting the market views to going to go down. So I would like to make money if I'm a speculator, or I would like to hedge my positions if I'm a an investor in the market, or if I'm holding the commodities, or if I'm an exporter. So in that case, so I'm going to be a hedger. I need to decide whether I'm doing it for hedging or I'm doing it for speculations. But my payoff from short future is going to be this. So what if the market comes down to 90? So I agree to sell at 100. So obviously, when the market price comes down to 90 also, I will sell my product at 100 rupees. So that's where I'm going to get an additional benefit of, or I'm going to protect my risk. So this is how it is. So whenever the price increases, okay, your profit increases, your maximum profit can be your selling price if the price is not going negative. If the price goes negative, and obviously the difference is going to be your profits. Similarly, when the market increases, so what will happen? You will be making a loss, and this is the payoff for futures.